Hi, this is Michael King. This is the first of two videos on capital structure, which is the choice of debt and equity when financing a company's assets. In this video, I'm going to introduce Modigliani and Miller's two propositions in a world without taxes, and then we'll relax that and look at what happens when you add taxes. Our focus is going to be on how changing capital structure affects the weighted average cost of capital and firm valuation. Franco Modigliani and Robert Miller were economists at University of Chicago who received the Nobel Prize for their work on capital structure. When they first started their research, there was no unifying theory. They established two main propositions that were controversial but allowed people to think systematically about how the choice between debt and equity would affect both the cost of capital for a firm and its valuation. Proposition 1, without taxes, says that the choice of debt and equity has no impact on a firm's market value. Proposition 2, without taxes, says that raising leverage also raises the cost of equity, leaving the cost of capital unchanged. In both cases, the assumption is that capital markets are perfect. Everyone has perfect information, there are no taxes, no transaction costs, and no costs of financial distress. Let's take a look at the world without taxes. You have two firms that generate the same amount of earnings before interest and taxes of $100 million, but they differ in capital structure. One firm is financed entirely with equity, and one firm is financed 50% with equity and 50% with debt. Now, Modigliani and Miller argued that if the markets are efficient, both firms will pay out the same cash flows and therefore should have the same valuation. In other words, it doesn't matter how you divide the EBIT generated by a firm, it doesn't change the value of the company. So whether you divide the EBIT between shareholders or between shareholders and creditors, it has no impact. The key to this conclusion is that an investor must hold both the equity and debt in the same proportion in which they're used in the capital structure to generate the same return. So no matter how you slice the pizza, it does not get any bigger. Take a look at these two firms, the unlevered firm on the left and the levered firm on the right. They both generate $100 million in EBIT. The unlevered firm pays out all $100 million to its shareholders in the form of dividends. The levered firm pays out $50 million in interest expense to its creditors and the remaining $50 million as dividends to its shareholders. Both firms are paying out $100 million, and no matter how you slice the pizza, it doesn't make it any bigger. But what if you were to invest only in the equity in the levered firm and not purchase its debt? Would that generate a higher return? Modigliani and Miller suggested that it would not. Even though you're taking on more risk and might expect a higher return, that is not going to be the case, because you could simply create your own leverage in the unlevered firm by borrowing to invest in the equity. An investment in the levered firm is the same as the investment in an unlevered firm, where you finance the purchase by taking out a personal loan from a bank. You would take out a loan, buy twice as much unlevered firm stock, you would earn twice as many dividends, but you would have to pay interest on your bank loan. At the end of the day, your returns on both investment strategies would be the same. There would be no arbitrage between the levered firm and the unlevered firm when it came to returns. What happens when we add taxes? Taxes are an implicit subsidy for debt because interest expense is paid prior to determination of taxes, whereas dividends are paid afterwards. In effect, the government is saying that debt is favored and is subsidized, and this subsidy goes directly to shareholders. As a result, the benefits of these so-called tax shields, or lower taxes, accrue to the shareholders in the form of a higher present value. As we can see here, in any given year, the value of the tax shield is the amount of the debt times the cost of debt, or the interest expense, multiplied by the tax rate. Because the tax shield is going to be received every year, we can view it as an annuity. To find the present value of that annuity, we would simply take each year's tax shield and discount it to today using a discount rate, which is the cost of debt. When we expand the formula as shown below, you can see that you have the cost of debt in the numerator as well as in the denominator. By eliminating the cost of debt from the top and the bottom of that ratio, we see that the present value of the tax shields is simply the quantity of debt times the tax rate. If the marginal tax rate is 35% and a firm has $100 million in debt, the present value of the tax shields to the shareholders is $35 million. Okay, so what happens if we slice the pizza with taxes? It appears that the pizza gets larger. In the case of the unlevered firm, $100 million of EBIT, after paying taxes of 35%, leaves only $65 million to pay out as dividends to shareholders. With the levered firm, however, they still pay the $50 million, leaving $50 million pre-tax. After deducting taxes of 35%, the dividends available to shareholders are $32.5 million. As a result, the total payout on the right is $82.5 million, which is larger than the payout on the left. How can this be? Well, Modigliani and Miller pointed out that there was simply a third recipient of the cash flows that was not being accounted for, the government. Now, if you include taxes paid to the government as a form of cash payment, you can see that the unlevered firm and the levered firm are still both paying out $100 million. In the case of the unlevered firm, taxes are $35 million and dividends are $65 million. In the case of the levered firm, interest expense is $50 million, taxes are $17.5 million, and dividends are $32.5 million. The pie has not gotten bigger even though it now has 3 slices. So what happens to the weighted average cost of capital when we add taxes? As you can see, the cost of debt is adjusted, making it lower by 1 minus the tax rate. If the tax rate is 35%, the cost of debt will only be 65% of its pre-tax value, making it cheaper. As a result, the weighted average cost of capital will be lower. Now, the benefits of tax shields are not certain. They depend on the company operating and having profits and needing to pay taxes. If the firm was to go bankrupt, it would lose the benefit of those tax shields. The tax rate is also assumed to be constant in the future. Let's look at an example where we start with an all-equity firm with no debt and look at its WACC. In this example, for illustration purposes, we assume the cost of equity for an unlevered firm with 100% equity and 0% debt is 10%. The weighted average cost of capital is therefore 10% because equity makes up 100% of the capital structure. Notice that as you add debt and decrease equity, the cost of equity goes up from 10% with 0% debt to 13.9% with 50% debt. As you add debt, the cost of debt goes up as well because with more debt, there's a greater risk to the debt holders of default. The cost of debt at 10% may be 4.9%, but with 70% debt, it may be 8.5%. Notice that after tax, the cost of debt is lower, and that the cost of debt, both pre-tax and after tax, are always below the cost of equity because these forms of financing are cheaper. When you take the weights and multiply them by the after-tax cost of debt and the cost of equity, you see the WACC in the far right column. It starts at 10%, but then declines to a low of 9.06% before increasing to a high of 11.7%. We can check and see that the low, in this case, happens to occur where there's 50% equity and 50% debt. It is not always guaranteed to be at a 50-50 point. It depends on the costs for debt and equity and how they change. The cost of equity here is going to be changing based on a formula we'll be showing later where the beta is increasing. The cost of debt is going up because of the increased credit spread or premium that's paid for the risk of default. But in general, there will be a level of debt and equity that will minimize the WACC and therefore maximize the value of the firm. Here, this picture illustrates how the cost of equity increases as you add debt. The debt to equity ratio on the horizontal axis is increasing from left to right. When the firm has only equity, the WACC is equal to the cost of equity. As you add debt, the cost of equity is going up, but because debt is so much cheaper, the weighted average cost of capital is coming down. Notice that the cost of debt is also increasing. At some point, the WACC will reach a minimum. In this figure, it appears that the WACC is always becoming lower as we add debt. This is an assumption that we will find does not hold in practice because of the costs of bankruptcy. Stay tuned for part 2.